You're listening to Smart Metals Radio from the Hard Assets Alliance.
Hello and welcome to today's show with me, Andy Duncan, coming to you from London. Our very special guest today is James Turk, the founder and former chairman and a current board member of Gold Money. He's also the author of a fantastic recent book, The Money Bubble. James is coming to me today from further down the River Thames here in London, and we'll be talking about his new book, The Future of Money and the Future of Gold. Hello, James.
Hi, Andy.
Now, since 1971, the entire world's been on a fiat monetary system based upon a paper dollar. In your excellent previous book, The 2004 Coming Collapse of the Dollar, you accurately predicted the 2008 meltdown 4 years ahead of time. However, since then, 6 years later, and the pre-existing global financial system is still in place. How is this possible?
Yeah, the bubble has become even bigger than what we suspected when we wrote the first book, The Coming Collapse of the Dollar. We basically said in that book that, you have to bet against the housing bubble, bet against bank stocks and things of that nature, and buy gold. And the main theme of the book was that, fiat currency is going to be repudiated. The dollar will collapse, and the dollar has collapsed against gold, but it hasn't collapsed to the extent that what we were expecting when John Rubino and I wrote that first book. And over the past year or so, with back in 2013, when gold started moving down, even though central banks were doing more and more money printing, we went back and reanalyzed all of our basic premises. And I think we're still on the proper main track, the long-term trend that the dollar is going to continue losing purchasing power, and gold is going to continue to go higher. But the bubble has been pumped up simply by all of this unprecedented money printing that's been taking place since 2008. And this wide belief, Andy, and this is really global, that central banks and the power of the state are able to correct all problems, even if it's totally out of historical norms. And what's really out of historical norms here is all of this debt that we have in the world. I just saw a report from the Federal Reserve that it showed the increases in the level of debt. The BIS recently just came out with a similar report. The debt growth since the financial collapse has been gigantic, and it's all been basically taken on by governments, corporations, individuals, and it's unsustainable. And ultimately, this is going to impact the currency. And I still think that the dollar will collapse. It's on the road, heading toward the cliff. You can never predict when it's going to get there, but as long as it stays on that road, and so far it is, it's going to go over that cliff eventually.
In your new book, you offer several predictions about what might happen next. These are a kind of Misesian cracker boom, Jim Rickard-style currency war, an overall just general deflationary collapse, even a cyber war, or possibly a global debt jubilee in which all the debts are forgiven. Now, although the future's unknowable, where would you say you'd put your own money on which one of these likelihoods is going to occur?
That's really hard to say. We put the 5 of them in there because we think they all have a good chance. And you actually might see a couple of them all happening or unraveling at the same time. But, given that my grounding in economics is Austrian School of Economics, and that, von Mises and Rothbard are, I think, the two people who I've learned the most about in terms of what money is and what it's all about. I'd have to go with a Mises-style crack-up boom. And I think we're seeing that already, Andy, in the sense that, all of this money printing, it doesn't show up all at once. It develops and appears over time. And you're seeing it, the super rich exiting the dollar, exiting national currencies, and moving into things. The collectible market is on fire. The classic car market is on fire. The art world is on fire. As well as I what's happening to real estate prices here in London and other places considered to be safe havens like Singapore. So the first part of the crack-up boom is that people start moving out of the currency, and the super rich get it. They're already moving out of the currency into moving into things, and eventually momentum is going to build. And what's actually happening here is we talk about the supply of money M1, M2, M3. But there's another thing that people generally ignore, and it's even more important than the supply of money in a fiat currency world, particularly, and that's the demand for money. And in a crack-up boom, not only is the supply of money increasing, but the demand for money falls. And whenever you have, decreasing demand, you get a lower price, or in the case of money, a lower purchasing power. And that means that the purchasing power of the dollar is going to continue to be eroded, but it's probably going to accelerate as the crack-up boom accelerates, as the crack-up boom moves faster and faster and gains momentum, which is, I think, what it's already begun. And I think we're going to see that acceleration during the course of this year.
Now, we might be starting to see the pedal going to the metal here, because although central banks are trying desperately to control things like long-term interest rates, they're actually going up, as are long-term gold interest rates. Do you think that we're within, say, 2 or 3 years of some kind of monetary reset?
Yeah, I think it's very close, but again, you can't predict it. We thought back in 2004 that it was going to happen within a few years, and we got the crisis in 2008, but they managed to paper things over, the so-called kicking the can down the road. But they basically run out of options here. The only reason why the debt load is being carried is because they've dropped interest rates to basically zero, and what they're doing is destroying capital. In not too many years ago, back in I'm in my 60s, I've been involved in business for 45 years. Back at the beginning of my career, you could talk about investments on the one hand and savings on the other. Savings is the accumulation of money itself in order to earn interest income, to enhance your purchasing power so that in the future you have more purchasing power than you do today. Investments are essentially a similar process, except you actually use your money to make an investment with the hope that that investment is going to generate more purchasing power for you in the future. But this whole concept of savings has been lost, and it's been lost because the currency is being eroded. And this icing on the cake in terms of the erosion of the currency is you can't earn any money when you have a deposit in a bank. And I think that's part of the factor that the super rich are moving out of currencies and moving into things. It's better to have a painting or a classic car than it is to have money sitting in a bank account, because of the loss of purchasing power. Plus, you have the other thing that has come into play recently, which was the Cyprus bail-in and the talk of having more bail-ins. So when you have money on deposit in a bank, you're going to potentially lose a good portion, if not all of that money, if there's a bail-in when the bank goes under. So all of these factors together are contributing to a decline in demand for national currencies. And this is what you see at the beginning of a crack-up boom. So again, we can't predict the future, Andy, but if I had a bet on any one particular scenario, I think it's going to be the crack-up boom, which essentially means, a hyperinflation of the dollar and a collapse of the currency. But time will tell.
Yeah, I think if any of our readers, any of our listeners are interested in this, they should get hold of von Mises' A Theory of Money and Credit, which describes all of this. Now, one country that you would have thought might have taken advantage of this might have been China, but they've actually printed $24 trillion worth of credit in the last few years, and we're starting to see now Chinese corporate bond defaults. Do you think China could actually be the pinprick where the bubble bursts? Will it be Europe, Japan, or North America, or will the whole thing go down as one big house of cards, do you think?
Yeah, it's interesting because for a long time I thought there's been a horse race between, Japan, United States, Britain, and Europe. And at any moment in time, one country was leading that horse race over the others. And it's not a race you want to win because it's a race to the bottom. But it's actually a 5-horse race. China's come out of nowhere. And I'd say it's probably leading at the moment. I think the way things stand, given the fact that we've had the warning shots fired last year, when Japan tried to crack down on the credit boom by raising interest rates and tightening up the money, and you had the big reaction. And now we're starting to see some of these corporate bonds starting to finally go bad because the money was just basically wasted. I would tend to think that this year, 2014, you're going to see China unravel badly, and that's going to have I think international repercussions, global repercussions, simply because China is the second largest economy in the world, and there's been so much money sent to China for investment and a variety of other things, and so much of that money has been wasted.
Okay, we've spent a while talking about the problem. Let's get on to the solution then. You think, I would suspect, that gold and silver should be returned to money. If gold is returned to money, what do you predict its price is going to be after we've got through the problem in terms of today's paper dollar?
Yeah, it's going to return to money, and it'll happen in one of two ways. Governments will either accept it willingly, or gold will just do it because market forces will force it upon governments to return to gold. What exchange rate gold will have to national currencies, again, this is impossible to predict. But, in the book, we've gone through a very detailed analysis explaining why we believe gold is undervalued and use objective mathematical formulas to show where gold is today compared to where it has been in the past to determine whether, how far undervalued it is. And, based on the various analysis we provide in the book, the fair market value of gold in dollar terms today is about $12,000 per ounce, which is quite far above where we are today. But it's an indication of how undervalued gold really is. Yeah, there's a bigger picture thing here I think we have to focus on, and it's basically the fact that gold has been money for 5,000 years. For 40 years, we've been trying to create a monetary system in which gold does not have a formal role. Whenever historically gold has been removed from the monetary system, you see the same problems developing that we have today. And eventually those problems cannot be solved because there's too much debt and the currency collapses. So, given that this 40-year experiment is not working, and it's never worked throughout history, to me it seems inevitable that we're going back to gold. But the bigger point, and this is what ties into the book, the whole title basically captures it, the money bubble and what to do before it pops. We're in a bubble because people have lost sight as to what money really is. And this is really an important point, Andy, because, we think that national currencies are money, but they're really not money in the historical sense of that word. They're only a money substitute circulating in place of money itself. Money comes, just like everything else in the world, from hard work. And I think the best way to explain this is that if you go into a shop and you want to buy, say, a man's suit, and I tell the shopkeeper, I'm going to pay for this suit next week. The shopkeeper has not been paid. I get the suit. He just gets a promise from me that I'm going to pay him. Now, let's use that same example, but instead of actually giving him my promise, I give him dollar bills or British pound notes or Chinese yuan or Japanese yen. I'm substituting my credit for the central banks or the government's credit to buy that man's suit, to buy that suit. But the shopkeeper still isn't paid. But if I go into that shop and pay for that suit with a silver coin or silver coins or a gold coin, the shopkeeper gets a tangible asset and he gives me a tangible asset. He gets the precious metal, I get the suit. Tangible assets are exchanged. There is no lingering obligation. There's no credit involved in that. And that's why gold is so undervalued today, because instead of actually using money, we're using all of these money substitutes, and people have lost sight of the fact that these money substitutes are entirely based on credit. And the sad thing is, if you go back and look at monetary history, and even if we know just from logic and recent experiences we saw in 2008, promises are broken. Credit is based on promises, and promises get broken. It's the way things are. Some promises just cannot possibly be fulfilled because politicians in particular make too many promises that they can just not get around to fulfilling. So, I think what we're going to see is a replay of 2008, but this will be the final replay where we finally understand once again what money is, and money is a tangible asset. It's the most liquid, tangible asset in the economy, and that's gold and silver.
Now, we'll take it as read then that you think our listeners should buy plenty of physical gold and physical silver and possibly sit like the Mogambo guru in a bunker guarding it. But do you think there'll be any other opportunities for our listeners to take advantage of when the money bubble bursts?
Yeah, there are. Wealth comes in two different forms. You have tangible assets and you have financial assets. Tangible assets do not have any counterparty risk. If you own a farm and it's free and clear of any debts, you own a tangible asset. That tangible asset can produce wealth for you. Financial assets, on the other hand, be they deposits in a bank account or insurance policies or T-bonds or anything denominated in a currency, those financial assets have counterparty risk. And the value of that financial asset is contingent upon the promise that the person makes to service that bond. And that depends on their financial capacity as well as their willingness to make good on their promises. So what you want to avoid is any type of financial asset and focus on tangible assets or what I call near tangible assets like stocks of mining companies or stocks of oil companies. Any stock in a company that is basically involved in tangible assets from which real wealth is being created. So I avoid the financial assets, focus on tangible assets. And when it comes to tangible assets, basically again there are two categories. You have investments or you have money. An ounce of gold really isn't an investment. It's just a form of money. It doesn't generate cash flow. And if you put it in a vault and look at it 20 years later, it's just still going to be an ounce of gold. What it does over that 20-year period of time is what money's supposed to do, preserve purchasing power. Investments, on the other hand, is you actually take your money and make an investment. You spend that money to purchase some kind of investment, and in the hope that something's going to generate a return for you in the future. So when you're looking at your portfolio, and this is all explained in the book, The Money Bubble. When you're looking at your portfolio, you have to distinguish between how much money you want to hold versus how many investments you want to hold. And that depends on a variety of different factors that is unique to everybody's individual situation. But being more conservative, you'll have more precious metals. Being maybe younger and a little bit more aggressive, you might want to have more investments. But everybody should have a good chunk of physical gold and physical silver in their portfolios. And I mean physical, because you want the tangible asset. You don't want some paper representation of gold or some paper representation of silver.
Okay, can I go for your personal portfolio then? I'm going to give you $1 million. What percentage of that would you put into gold, silver, and other things?
Well, the rule of thumb that I generally use, and again, it's difficult to make a specific recommendation because everybody's circumstances are different. But in terms of a sweeping generalization, I say use your age. This year I'm 67, so I would put 67% of my portfolio in precious metals, physical gold and or physical silver, depending on how you want to balance those two. And then the remaining 33% would be in investments.
Okay, just my last final question. When everything does start to go wrong, the last people the politicians will blame is themselves, despite them paying themselves with our money to manage our problems. They'll probably blame people like us, gold hoarders and speculators. How can our listeners stop their precious metals being confiscated by politicians?
Yeah, that's really a good question. The best answer is to mitigate risk. Diversification makes sense. It's really the only strategy that one can use to plan for an unpredictable and uncertain future. And the way to mitigate your risk and by diversification is to own your physical metal in different ways. When you buy physical metal, there are only two things you can do. You buy it and you store it yourself, or you buy it and have it stored for you. Now, both of those different alternatives have advantages and disadvantages, but you really should be doing both in order to get some diversification. And when you use professional storage, make sure you have all of the governance and audits and things like that are in place so that that your gold and silver are safe. But when you're using professional storage, diversify there as well. Like what we do in Gold Money is we offer 7 different vaults in 5 different countries around the world, so that you're sitting in the United States. You can store gold in Singapore or Hong Kong or Canada or London or Switzerland very, very easily. And it's a way of having your tangible assets, your nest egg. They're not all in one basket. They're diversified in different parts of the world. So that's really my recommendation. You don't know how politicians are going to react, but the best thing to do is to diversify one's assets globally.
And that's the Doug Casey International Man approach. Now that you've retired then, James, from being Gold Money chairman, I just wanted to ask you about your book. Did you just write it for the good of your soul, or is it the foundation of something else?
It's really because, over the years, so many people have been, first with the first book and then all of the work that I've done through Gold Money have been following, what I've been talking about. And when gold started going down in the beginning of last year, I wanted to check and question all of my premises. And one of the things I've done throughout my career, Andy, is that I always use writing as a way of analyzing what's happening. Once you've written something, it's there, and you can't deny that you didn't write it. And so I use it to show, first of all, what my thinking is, and because gold went down contrary to what I was expecting, I had to reanalyze all of my basic premises and make sure that my initial analysis was still correct. And that's basically what we've done. But what John and I did this time around, we brought in all kinds of new things that we didn't have in the first book in terms of looking at gold, looking at the global situation, and looking at, even new things like cryptocurrencies. That wasn't even around when we did the first book back in 2004. But things like cryptocurrencies, given the fact that we have new circumstances today, have to be viewed when you're looking at, what do you do with your portfolio? How do you protect you and your family against an uncertain future so that you're protected come what may?
Well, you were very kind to send me a copy, and I've read it, and I think it's superb, and I can heartily recommend it to our listeners. But that's mainly because you've quoted me in it, and I think that's the very best bit of your book.
Now, you've done some very good work in the past in terms of your analyses, and that quote in the book was very well deserved, Andy.
Okay. Thank you very much for your time today, James Turk.
Thank you very much, Andy. It was really great speaking with you.
Subscribe to the Smart Metals Radio Show on iTunes. You can also visit us online at hardassets.com/radio, where you can subscribe to our free mailing list and receive our free Smart Metals newsletter. For anyone who wants to set up an account with the Hard Assets Alliance as a special offer, we shall be waiving opening and setting up fees. Listeners who'd like to speak to a live rep to walk through the registration process can call 1-877-727-7387. That's 1-877-727-7387. I'd like to thank James Turk for joining us on today's show, and I'd like to thank you for listening. Until next time, goodbye.